We have big news from the RBA. They've decided to increase the cash rate by another 25 basis points. So in this video, we're going to unpack the recent statement from Philip Lowe, the governor here of the RBA, and talk about how this might have an effect on the property market here in Australia. Have they gone too far? Why did they bother taking a pause for a month and then look to increase it anyway? Is Australia's inflation data not really accurate or keeping up with the times? Let's read about it. At its meeting today, the board decided to increase the cash rate target by 25 basis points to 3.85%. It also increased the rate paid on exchange settlement balances by another 25 basis points to 3.75%. Inflation in Australia has passed its peak, but at 7% is still too high, and it will be some time yet before it's back in its target range. Given the importance of returning inflation to its target within a reasonable time frame, the board judged that a further increase in interest rates was warranted today. Now, this is going to hurt a lot of Aussie mortgage holders who are on those variable rates. There's definitely some people who haven't been part of the mortgage cliff yet that they've been talking about. There's definitely still some people on those great fixed interest rates at 1.99%, at 2.69%. There's a bunch of other people who have shifted onto those variable interest rates and are going to be hurting now. So another 0.25%. This is all they have to work with. It's a very blunt instrument in using interest rates to put pressure on inflation and to manage Australia's economy. And they're doing what they can to push that inflation down from 7% towards the target band of 2 to 3%. The really interesting thing here is how that's going to affect property prices and what the expectations are of the RBA about the economy going forward. Now, the board held interest rates steady last month to provide additional time to assess the state of the economy and outlook. So they took that month just to sit around and work out what was going on and see if they wanted to be more aggressive. And I think a lot of people had hoped that they wouldn't do another cash rate rise, but a lot of people also expected it to come through. While the recent data showed a welcome decline in inflation, the central forecast remains that it takes a couple of years before inflation returns to the top of the target range. Inflation is expected to be 4.5% in 2023 and 3% in mid-2025. So these are those projections that are out in the next 1 to 2 years around what's going to happen in Australia's economy. Goods price inflation is clearly slowing due to a better balance of supply and demand following the resolution of the pandemic disruptions, but service price inflation is still very high and broadly based, and the experience overseas points to upside risks. Until labour costs are also rising briskly, with productivity growth remaining subdued. So basically what the RBA is saying here is that they're going to keep the cash rate high, and they're hoping that inflation is going to come down to around the 4.5% mark this year and the next year, the next 12 months, and around to that 3% mark by mid-2025. So they're looking at a 2-year horizon to get inflation back into that target band. Now, the real interesting thing for me is what's going to happen to property prices. Property prices have actually risen across a lot of the major capital cities in the last 2 months. People are getting confident around their serviceability and where the cash rate is heading. I don't think a lot of Australians expect the cash rate to go much higher from here. I don't expect it to go much higher from here. I think we're more likely to sit in this environment with the cash rate around that 3.5% to 4% range for the next 12 to 18 months. So this cash rate at 3.5% and interest rates at around that 5.5% to 6% is probably factored into property prices and people's borrowing for the next, say, 6 to 12 months. What this means is confidence has been returning the last 2 months, and that's why prices have risen. There's also been dramatically lower stock levels. We've noticed it on the ground here in the buyer's agency at Purpose Property that there is lower stock out there, especially in those in-demand areas, on those great block sizes, in those good locations. Property is scarce for those types of deals. And so when we find the right opportunity, whether it's on market, off market, or pre-market, it's about taking decisive action and making a strong offer within our value range that makes sense for us. So when we're working with any of our clients, it's about finding the right property for the right price in the right location. And a lot of that comes down to you understanding your numbers. So if I was running forecasts, I'd be running all my numbers at 8% in my own portfolio, or 10% is what I like to stress test things at, just because I want to know there's a lot of headroom in my property portfolio. The banks are going to be adding 3% to your current buffers anyway. So say we're at this 3.85% in terms of the cash rate, and you're at 5.85% in terms of your lending with your bank, you're probably getting assessed at 8.85% by the bank in terms of your serviceability. So if you're running your numbers at 9 or 10% across your current investment debt and your property portfolio, you know you're going to be quite conservative in your calculations, looking at your income and looking at your expenses. Another interesting point in today's announcement for the RBA was the commentary around consumption. So, a significant source of uncertainty continues to be the outlook for household consumption. The combination of higher interest rates, cost of living pressures, which we've heard a lot about the last few months, and the earlier decline in housing prices is leading to a substantial slowing in household spending. While some households have substantial savings buffers, which we absolutely know there are a lot of Aussies with money sitting in their offset accounts, and others are experiencing a painful squeeze on their finances. There are uncertainties regarding the global economy, which is expected to grow at a below average rate over the next couple of years. So I think we're seeing more of a two-horse race here, especially with the increased interest rates. Some Aussies are really struggling at this point in time. Cost of living has gone up, both on the rental front and on the service expenses and the products and goods that we buy every day. And some people are really well buffered and have quite a good position. It's different for different Aussies. And so the RBA is trying to manage the economy as a whole and make sure that we keep things ticking over, not too much inflation, but not too little. And so it's going to be an interesting period over the next 6 months as we look out towards the end of 2023, because a lot of people are expecting good buying while there's still some uncertainty in the market. The real sticking point for me is when the groupthink comes back. When are most investors and most Aussies going to go, I've got the finances, I've got the capability, and I've got the motivation to jump back into the market, whether it's for my own home or whether it's for an investment? That's when the price is going to continue to drive on over the next few years. Now, it might not be straight away. So it might take 6, 12, 24 months for that type of interest and demand to come back into the property market. Or we could see it sooner if everyone starts thinking the same. And so that's where that groupthink comes back, is when are the bulk of people going to think it's a great time to buy? I'm definitely hearing whispers on the ground and knowing through my buyer's agency what type of demand there is at the moment. And I've seen it pick up. I've seen people getting interested in the market. Now we've got a much better view on interest rates. Now, in my opinion, I don't think this interest rate environment is out of hand. Yes, we've seen the cash rate jump 11 times now, and interest rates have risen significantly in a short period of time. But that aside, the actual interest rates that are being charged on the debt that people have are not astronomical. We're not seeing 10% interest rates from these big four banks. We're seeing 5 to 6%. Now, 5 to 6% in terms of an interest rate to me is very reasonable for an investment property. You're looking to buy property for the long term, not the next 3 months, not the next 3 years, but more the next 10 years plus. And so with that view to the long-term vision of building a property portfolio, getting a 5 to 6% interest rate with the tax benefits that you get for property, with rental income servicing some, if not all of the debt, depending on that purchase price and the rental yield, and your ability to continue to scale and grow that property portfolio, i.e. build the volume. Now, that's where the real key to success is that long-term vision. So Emily and I have done that. We've looked to build a $5 million plus property portfolio. And that volume, when you get growth on a $5 million property portfolio, as compared to a $1 million portfolio, that growth is the real game changer to allow you to create equity and create value. On that value, you're also going to see a relative rental yield. And that's where the cash flow can come in as well. So if you're looking to continue to scale, this is how I see the next few years. I would continue to look at those growth property assets in the initial instance if I was starting out from scratch again. I would then also look to balance with cash flow properties. I sit somewhere in the middle between the growth and the cash flow play. You see a lot of people buy a lot of cheap properties, make sure they're all cash flowing. This will suit you really well in this high interest rate environment. And you see the other end of the spectrum. I want to buy in Sydney and Melbourne in a CBD within 5Ks of the city and go for absolute growth, even if the cash flow is strongly negative. Now for me, I want to own a couple of properties in each camp. And in terms of the timing, I generally want to go for the growth properties first because that's where I'm creating net worth and equity. And then I want to transition to pulling levers or buying properties that bring me cash flow. Whether it's through granny flats, whether I'm doing a subdivision and building that second property, whether I'm buying a unit block like Emily and I did in Coffs Harbour, I'm starting with growth and then adding cash flow properties to create that passive income and have that scale of portfolio like Emily and I have done to the $5 million mark. So I think this is big news in terms of the interest rate environment, seeing another 0.25% increase or 25 basis points on the cash rate. I personally thought they might have held for another month or two, given that they were willing to hold last month and not continue the increases. But I also think the RBA has been getting a lot of pressure after 10 consecutive rate rises, and they wanted to break that consecutive streak. So they've done the 11th after taking a month pause. Now, we may even see another rate rise late this year. And so I'd love to hear your thoughts. Let's have a guessing game down in the comments below. Whether you think that's going to be August, September, October, or do you think it's even going to be sooner and they might do another rate rise next month? I'd love to hear your thoughts in the comments down below. Now, if you want to see a breakdown of the portfolio that Emily and I have, and the incomes and all of the expenses associated with it and how we build our passive income, then you can click this video over here. Drop a like on this video, subscribe to the channel, and I'll see you in the next one. Peace.